Hello everybody and welcome back to the Global America Financial YouTube channel. I'm Rodolfo Sierra and today I'm coming at you from home. Decided to take a work from home day given it's President's Day and not head into the office. And today I want to talk to you about taxes and how they play a critical role when it comes to retirement planning. So first off, a couple questions. Whenever you make money, do you pay taxes? Yeah, get a paycheck, you pay taxes, right? Whenever you spend money, got a little receipt here, right? You spend money, you have to pay taxes. And whenever you save money, do you pay taxes? That's a tricky one, right? Well, how about if you have money in a savings account, you usually get one of these little 1099 forms. Oops, backwards. There it is. 1099 form at the end of the year, interest income. You pay a small amount of money on the money you saved. All right? And the fourth question is, whenever you die, do you have to pay taxes? Yeah, probably, all right? Probate, estate, there's probably some taxes. So when you're trying to plan for retirement, doesn't it make sense to try to minimize or just eliminate taxes as much as possible? I would say so. Well, luckily there's three strategies we can use to do that. First one being tax deductions. Mortgage interest, or if you have a business and business expenses, you can deduct your taxes, so you pay less throughout the year. Second phase is tax deferrals. Right? You don't pay taxes today, you defer them to later on. So you defer your taxes. You don't pay now, you pay later. And the third way is income tax free. That's how I like my money. Right? You don't pay taxes at all. You get it all tax free. So that's the best way. So when we're trying to plan for retirement, we have to also think about the different phases of the life cycle of money, right? When it comes to retirement planning. And there's four phases. There is the contribution phase, there is the accumulation phase, there's distribution phase, and the fourth being transfer. Let's kind of go through all those. First one being contribution. What does that mean? That means you're contributing money towards some type of program, right? You're putting money into a savings account, putting money into an IRA, 401k, whatever programs are out there, right? So your money can either go pre-tax, so you pay taxes later, or you do after tax, so it could potentially either come out tax-free later on. So your choice, how you contribute money towards your account. Second phase is the accumulation phase, right? That means the money accumulates or grows over time. And there's two ways you can do that. You can either pay taxes all along the way, pay taxes up front, or you can do tax deferrals where you just pay taxes later on, right? Third phase is distribution. That means you're distributing funds from your accounts, retirement accounts, which means you've retired at this point and you're taking money out, right? You're using it for retirement purposes. So you're distributing the funds. You either can pay taxes on all that money, or you can try to, not pay taxes at all and receive that tax-free, and that's my preference, of course. And then the fourth phase is transfer. And a polite way of saying whenever you die, money transfers from you to your heirs, right? And you can either minimize taxes or not pay taxes at all or pay a ton of taxes. It's your choice on how you structure your programs, right? So the four phases are the contribution phase, the accumulation phase, the distribution phase, and the transfer phase, right? You want to try to minimize taxes as much as possible along all four of those. Well, now let's go walk through about three examples of some products you probably all have or own or know of that are common when it comes to retirement planning. So the first one being your stocks and bonds. So you buy some stocks off of an E-Trade account or some type of online platform, right? Scottrade, and you usually buy a stock after tax. So you already pay taxes on your money and you buy a stock after tax. Typically on the growth, depending on how long you keep it, there's some taxes to be paid along the way, short-term or long-term gains, right? And then when you start taking that money out from that, these are fees or taxes to be paid and distribution. Whenever you die, there's any taxes, any stocks that are left there, there's probably some taxes to be paid. So stocks, you pay taxes on every single phase there. Your contribution, accumulation, distribution, your transfer phase, right? Second option is a 401k, right? Almost everybody out in the world has a 401k this day and age, right? If you're a teacher, 403b, 457 if you're a government employee, right? A lot of different options out there. But typically with those programs, we usually put money or contribute money into that pre-tax, right? So we get to save taxes on it today, take the tax deductions, and then it accumulates tax deferred, so it grows tax deferred, no taxes paid over the 5, 10, 15, 20 year time frame, 30 years, depending on how long you have until you retire. And then when you take that money out is when you get taxed, right? The distribution, right? You haven't paid taxes at all. You haven't paid taxes on the contribution. You haven't paid taxes on the accumulation. So when your nest egg at retirement comes out, you have to pay taxes on that money that gets distributed. And then there is the transfer phase, when it comes to your 401k. Depending if there's any money left there, hopefully there is, you can leave some behind to your heirs. There's probably some taxes to be paid on that. And then the third program is some after-tax alternatives, right? So what are those options? Roth accounts and those types of programs out there. So usually with those, you contribute money after tax, so there's no taxes there's taxes to be paid there, right? So, but it grows tax deferred because you're gonna pay taxes on it. No taxes on the growth. That money comes out income tax free, right, on distribution, and it gets transferred to your heirs tax free, right? So your after tax alternatives is after tax contribution, tax deferred growth during accumulation. It gets distributed tax free, and it gets transferred tax free. Pretty cool deal, right? So you have to really think about your taxation on your retirement programs. It's a big deal. Our philosophy is thinking about, a simple example is a seed and a harvest, right? So if you're a farmer and you're going to plant some seed out there, you have to determine how do you want to pay your taxes. Do you pay your taxes on the seed today so that your harvest comes out tax-free, my preference, or do you not pay taxes on the seed so that when your harvest grows over time, you get taxed, right? So 401k is an example of not paying taxes on the seed. So whenever your harvest comes out at retirement age, your nest egg, it all gets taxed, right? That's not a good thing, in my opinion. You want to try to minimize tax as much as possible. So pay taxes on the smaller amount versus paying taxes on the bigger amount, right? So that's my purpose of the conversation today. Just to want you to think about taxation, how it plays a critical role when it comes to retirement planning. You want to try to minimize it as much as possible, eliminate as much as possible, right? Because one of my favorite quotes is from Robert Kiyosaki. He says, it's not how much money you make. It's not. It's how much money you keep, how the money works for you, and how long does that money last from a generational standpoint. So think about that when it comes to retirement planning. I want to thank you for joining us today at our Global America Financial YouTube channel. If you would, please subscribe below. And actually, I wrote an article about this on LinkedIn, which I'll attach on the bottom here in our comments. So again, please subscribe. Thank you for spending time with us today. Look forward to see you again. Until next time.